Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. On this episode of the Wealthy Behavior Podcast, we are sharing our 2025 Market Outlook webinar. Chief Investment Officer Bob Weisse, who I talk to at the beginning of every month about the investment world and things you need to know right now, and Brad Long, Managing Partner and Chief Investment Officer at the investment consultant we work with, Fiducient Advisors, are getting together to talk about the market and our outlook for this year. Full valuations, index concentration, and the potential for a resurgence of inflation have set the stage for a fragile market environment. Can prices rise further from here? Absolutely, but the possibility of setbacks is equally real, underscoring the importance of durability as we head into 2025. Hope you enjoy it.
Good afternoon, and thank you for joining today's 2025 Market Outlook. I'm Bob Weisse, Chief Investment Officer here at Heritage Financial, and I'm joined by Brad Long, Chief Investment Officer at Fiducient Advisors. Welcome, Brad.
Thank you.
Fiducient is an investment consultant that Heritage works closely with. They advise on over $300 billion in client assets under advisement. One of the main projects that we work with Fiducient is our annual Capital Market Assumptions project. These are long-term market forecasts that inform our market outlooks and portfolio construction decisions. We are looking forward to sharing an update on today's market and economic environment and reviewing some of the recently released 2025 capital market assumptions. Before we begin, I just want to mention a few logistical items. One, if you have a question, please type it into the Q&A. We'll monitor questions during our discussion and we'll do our best to address them. Two, a recording of this webinar will be sent to all registrants and shared on Heritage's website and YouTube channel. And three, investments and financial planning are very personal. If you have any questions pertaining to your situation, please feel free to reach out to us and we'd be happy to discuss with you after the webinar. With that, let's get started. So Heritage at a glance. Heritage now manages over $3 billion in client assets under management. We have clients in 36 states, 46 employees, and our mission is to make a positive and lasting financial impact on the people in our lives and those we serve. Now, Brad, I'll kick it to you to start off our 2025 outlook.
Great. Well, we'll cruise through here because we got a lot to cover, and we know many of you sent in some great questions ahead of time. So we'll try to get to those, as Bob mentioned, throughout, but put them in the queue if you have them. So maybe just quickly looking in the rearview mirror before we look out the windshield and just talk about 2024, some of the positioning and how that affects our views for 2025. So three primary themes come into the year: messy middle of inflation, prepare not predict, and concentrated consequences. So the messy middle of inflation, look, inflation has and did moderate. I would emphasize the word messy around inflation, and we'll get into that and the impact of 2025 and how that's influencing our portfolios and allocations. But there's probably going to be some more work to do around inflation, and we'll talk about why. But 2024 in particular was a fairly benign year on the inflation front. Remember, coming into 24 was coming off of the year of 23, in which every economist was certain that a recession was going to occur in 2023. Yet here we sit in 2025, and none of which has occurred. Those that have gone to cash and just kind of wait in the sidelines for the smoke to clear have had a fairly expensive waiting period. The S&P has had 2 years back to back of more than 20% in returns. So those that were trying to kind of predict or time the markets and went to cash, of which there are many, there's $6 trillion sitting in cash and money markets today. That was a big opportunity cost. So this is not as much a theme for 2024 as it is just an investing ethos or mantra, right? We want to think about how we prepare for what the markets may provide, not try to predict in time. Those end up being market movements or portfolio movements that really hurt returns over time. And then concentrated consequences. Look, 2024 was nothing but a year of concentration was good for you. And the fewer of those handful of stocks that you own, the better the total return. And or the more you owned, the fewer, the less the total return. And we'll talk about what that does for portfolios, positioning, and our outlook for 2025. So with that, we'll roll into what we think are going to be the key components and variables that are going to be driving prices in 2025, which obviously influences our thoughts on risks that exist and opportunities that exist. The first is this idea around fragility. So we think markets have some underpinnings that make them particularly fragile in today's environment. The three things that are really driving that are one, valuations. Markets are fairly expensive, and that's in particular US large cap, right, which has been the belle of the ball for the last decade, is fairly objectively full valuation. Does that mean that stocks will fall in 2025 or this quarter or next quarter? No, it doesn't. But it does mean that with high valuations comes high expectations and lower opportunity for forward return. The second is concentration. We know concentration exists, but we'll punch through what that really means to our portfolios and how we potentially mitigate it. And this concept of inflation, which I mentioned, the emphasis on messy. We'll show you some of the things economically, but also, some of the perhaps which many of your questions were around political changes that may be influencing and tipping the scales of the probability of inflation rising or the probability of inflation falling. And so those preconditions of high valuations, high concentration, and the risks of inflation rising build what we think is a more fragile position for markets, which means we believe portfolio durability is perhaps more important today than it's been ever before. And so we'll talk about that from not just an asset allocation, how much you own in stocks versus bonds versus real assets or alternatives, but also the mix of those, which Bob will get into later on. What do we own within fixed income, within equity, within alternatives, et cetera. Finally is this concept of the age of alpha, right? Those preconditions of fragility that we were talking about, high valuations, concentration, and inflation, those are also conditions in which might benefit certain asset classes or active management to add more value than is typical. Now, that doesn't undermine, 50 years of data on where markets are efficient or inefficient, but it does give us, kind of leanings into how we want to position portfolios for high probable outcomes for 2025 and beyond. So that's kind of setting the stage for 2025 and looking out. But we do think undermining that, right? We want to start maybe at the highest level. So we'll give you a bit of the economic backdrop, and maybe using that analogy, we'll start at kind of cruising altitude of 30,000 feet and then work our way down into some of the portfolio allocations, which Bob will share with you in a moment. So let's talk about the economy first. Look, the economy has been robust, right? Much to the chagrin of economists in 2023 and even some still in 2024. You can look at a number of statistics. The current low unemployment rate, GDP, inflation has been modest. So a number of economic factors are firing and the economy has been growing. But you don't have to sit too long with this graphic to start to figure out that not all factors are flying. So let's break this down a little bit. Assets, those are things that are economic variables that are going well for the economy. Liabilities, things that aren't going well for the economy. And then those that sit neutral, right? They're neither an asset nor a liability. They kind of, sit in between. And, that idea, that precursor that we were talking about, fragility, from an economic perspective, right? It doesn't take a lot to envision some of this middle column either shifting to the left and being bullish or shifting to the right and being bearish for a whole host of issues, which we'll start to get into in just a moment. And so, as we think about the economy, it has been robust. There is a good and strong economic backdrop, but it's not, in the analogy, it's not a freight train that's unstoppable, right? We do think that the, economy is growing, but, there's kind of cracks, not breaks, if you will. And that helps kind of underpin that notion of fragility. Now, many of these individual variables are also influenced by the new administration, which just took office in this past week. And many of your clients were around, or many of your questions were around the potential impacts from the new administration. I would say first thing we would say is there's a big difference between politics, policy, and market outcomes, right? 2024 was the year of politics. You kind of say or do whatever you need to do to get elected or reelected. Then there's policy, things that actually come to fruition that can start to have influence on markets. And then there's actual prices, right? Money moving in markets and where we make money or lose money. So we're not political strategists. Bob and I are not going to sit here and say, because this senator said this to this person that, this will happen. But we are well aware of what is going on in Washington and the potential influences for our portfolios and allocations. So for this exercise, right, because some of this is still unknown, even with the new administration officially taking office this week, there is still some tea leaf reading here. So what we focused on here is executive order things, right? The things the new administration has either unilateral or more control over on their own, rather than those that take legislative action. So think about tax policy. That's going to be an important discussion in 2025 that takes an act of Congress and the Senate and the approval of the executive branch to affect tax policy, not an executive order and a signing of a pen earlier this week. So, focusing on some of the things that are influential to our portfolios, but are perhaps more seeable because they're executive order, we have the following on the page. Tariffs, the Fed, kind of a grab bag, if you will, foreign policy, M&A, deficit policies, and then immigration. We could spend a whole hour going through these individually, which we won't, but we'll give you kind of some of the tea leaves of influence in portfolio. First is tariffs. Tariffs, I would say the number one thing here is, they're potentially inflationary. Why? Usually when you implement a tariff on a foreign country, there's a retaliatory nature to that. They implement a tariff on the United States. Most of those costs increase, pass on to consumers through higher prices. So, a lot more detail behind how that's actually implemented, which countries, what levels, but it's certainly something we're watching and skews that risk of inflation higher. Politicization of the Fed. Some of you may have heard Chairman Powell's term isn't up until May of 2026, so it's not something you have to quote unquote worry about today. But it is one where we would say hopefully cooler heads prevail. The Fed really has two mandates: full employment and price stability. What that means is an owner of treasuries, right, which we are, right, as individuals or foreign entities are, it means full employment means a higher probability of getting paid back on the debt that's a loan to the federal government. And price stability means that the value of that money that you lent won't be eroded through inflation. The more political influence to affect short-term outcomes and the less focus on those two objectives potentially means a higher cost for federal deficits. And that's not a game of chicken anybody wants to play. We have high debt to GDP levels today here in the United States, and over a third of US Treasury debt is going to come due within the next year. So it's not a 10-year item, it's a today and tomorrow item. So hopefully the politicization of the Fed is more discussion than actuality, but we'll be watching that in the coming months. Got a bit of a grab bag here on foreign policy. That could be obviously the Middle East, Russia, Ukraine, Taiwan, Basel III deregulation, so banking potential deregulation, M&A. So Lena Khan is not be considered, a close friend of the markets, and M&A transactions. Obviously, with new administration in there, that might change and pick up and increase in the IPO market. DOGE, or the Department of Government Efficiency. Your guess is as good as Bob and mine. It could be. It's hard to argue with the theoretical concept of efficient government is bad, right? It could be a good thing. Devil's in the details, though. I think if I had to take a guess, if you X out defense and if you X out entitlements, that's the majority of the US government spending. And so it's hard to really affect efficiency without touching either of those things. So we'll see more there. And then deficit policy will be important over the long term. I will say immigration is one, though, when we think about nearer term consequences, could be more material in markets. If you think about today in the economy that we just walked through, we have a tight labor market. Unemployment is low, so there's not lots and lots of available labor. The degree to which we either restrict incoming labor, so foreign-born labor, which is an important part of the American economy and has been for a long time, or we deport existing labor, estimates of 1 million to 8 million people. That means less labor in a market in which doesn't have a lot of free labor. or capacity. So wages go up, inflationary pressures go up, and that can get on that spiral again. So as you can kind of tick through this page here, there's a lot of detail that would need to be discussed, but overall, it increases that risk of inflation higher, which we think is important as we think about allocating capital in markets today and risk and opportunity. Now, one of the things we haven't talked as much about is concentration. I think we all know, or we've heard either in the media or from us, markets are concentrated, but many don't internalize like what concentration truly means. In the rear view mirror, concentration has been basically nothing but good. The top 10 stocks have performed extraordinarily well, and they've driven the vast majority of the S&P's return. But what happens if concentration's not your friend, right? If it's not a tailwind, or it just becomes neutral or a headwind. So we produce this somewhat stylized examples of, let's say in that first column, if the top 10 in the index were to return 0% in 2025, and the remaining constituents, 97% by count, return that kind of prototypical long-term return of 7%, the headline return of the index would fall from 7 to 4.5. So a 40% haircut just because the top 10 took a break. So you can start to get the sense of the materiality or the consequence of concentration in the index. And that's just something as allocators, right? As we're thinking about opportunity, as we're thinking about risk and overall portfolio construction, it's very important for us to understand kind of the intuition and the math behind it so we can manage it appropriately. And sometimes it's harness it in the right way, and other times it's mitigate it in the appropriate way to make sure that it's not creating undue risk in portfolios. Now, the trillion-dollar question, quite literally, is will concentration be a friend or a foe in the future? And look, nobody knows. If someone tells you they know, they're either lying to you or themselves, right? No one really knows what NVIDIA is going to do in 2025. But we can use history to set ourselves kind of on path to say, how likely is it that a handful of stocks just continue to be the belle of the ball? This graphic is constituents of the S&P from 1985, and in a given calendar year, their sales growth of light blue line is 10%, dark blue line is 20%. So you can see in a given year, it's not uncommon or perhaps even likely that an individual company would grow 10 or more percent in a given year. But if you start to add that to consecutive years, right, they do it year in and year out, you can see the decay of that line falls fairly quickly. So it's hard to, as the title implies, keep the party going for a handful of securities. And that's just part of the economic machine, right? It's a competitive environment, technology changes, dynamics can change, consumers change. And so to have that level of continued success over such a long period of time is a difficult thing to achieve. And so, as we think about that notion of concentration, we want to recognize that it's not a forevermore, even though it's easy to look in the rearview mirror and think it has been this way for quite some time. Therefore, it will be that way going forward. History would certainly tell us something different. Now, as we look at markets in general, one of the things we talked about from fragility was valuations. And valuations are full in markets. Here on this graphic, we have the forward price to earnings. It's a very common way. The higher the number, the more expensive markets are. The lower the number, the less expensive markets are. But you could almost take price to earnings and trade it for really any other value. Price to sales, EV to EBITDA. You can look at the Conference Board survey of investor expectations. Valuations are full. Basically, markets, especially large cap US, are expensive. Moreover, the expectations from investors are that earnings will continue to rise in a material way. And it's hard, again, to keep the party going, to set those expectations relative to where we are in markets today. So this graphic kind of helps display that. We, in September of last year, entered a cutting cycle. The Fed started cutting. They came out of the gate with a bang. They came with 50 basis point cut. They cut another subsequent 50 basis points over two 25 basis point cuts over the fourth quarter. So we're at a cutting cycle. Right now, markets expect earnings to grow in 2025 by 21%. That's a robust level of growth. Historically, during a cutting cycle, earnings grow by about or fall by about 6%. So right now, expectations are saying it will be different this time. And again, as we think about fragility, we want to keep that in mind. So now we get into durability, right? And one of the most important things about durability is thinking about relative valuation. The first and probably one of the most important conversations about asset allocation is the mix of stocks and bonds. It's going to drive a lot of the volatility and the return potential over the long term. Today, as we look kind of in through the windshield, right? We're looking forward, not in the rear view mirror. Our expected return difference between stocks and bonds is very, very modest. While we think stocks will outperform bonds over the next 10 years, they're doing so by a very small margin. And so in today's landscape, right, when you're building durability, you can own fixed income, and we do own fixed income at a fairly cost-effective way, and it won't erode return materially relative to owning more equity. And so this is kind of one important conversation as we think about positioning portfolios for the year, is just kind of the relative value of stocks versus bonds. But it doesn't mean kind of, sell everything and go to bonds. Again, kind of in a prepare, not predict world, that would not be well advised. And for one of the reasons is that, inflation is important to bond prices. Higher inflation means higher bond volatility. We experienced that in a very acute way in 2022. With higher inflation, stock and bond correlations actually rise. And so this is where we think, in an environment, alternatives, can play a role. That's real assets for a host of reasons, which Bob will get into. It could be private debt or private equity in certain instances, but thinking about diversification holistically. So, with that as a very kind of long and detailed backdrop, Bob will kick into, some of the underlying allocations and updates for portfolios in 25.
Yeah, sounds good. Thanks, Brad. So wrapping this up, our overall posture, starting with top left, we think it's not time to reach. There's few fat pitches, excuse the baseball analogy, but basically we're saying that the market has a strong appetite for risk right now, and therefore taking risk is priced to deliver a low return. So on the kind of greed and fear index, it is not time to be greedy. Relative risks influenced by exogenous factors, absolute risk less attractive on full valuations. So again, we're seeing fairly full valuations across the marketplace. The top right, we think this is important, allocation balance. So confirm risk aligned with ability. When you invest and build an asset allocation, the textbooks teach us to set investment objectives based on your willingness to take risk and financial ability to take risk. Willingness is more of a personal, emotional thing. Financial ability is crunching the numbers and what's your true ability to take risk. At these levels, it's a good time to meet with your advisor and make sure that you're taking the right level of risk. If you're not a client, it's a good time to come in and check your allocation and get into the right level of risk. We'd hate to see a downturn happen and then someone come in and say, hey, I think I'm taking too much risk. So now's the time to do it, in our opinion. Down below, inflation repeat. Brad talked about this. Fundamental factors pushing risk of inflation acceleration up. There's geopolitical and political factor uncertainty. So inflation was up to 9%. The Fed has brought it down to about 3%. Their goal is 2%. They haven't been able to get it to the target of 2%. And there is a risk that it remains at 3% or reaccelerates higher. And then with portfolios, prioritize durable returns and be mindful of inflation upside in allocations. So these are all high-level thoughts. If you take this and boil it down to actual trades that our end clients are seeing or specific recommendations, there's really a few themes that we're doing. It starts with reducing equities. In most portfolios, it's reducing equities by 1% to 4%. And then with that reduction, we're adding to fixed income. Within fixed income, we're increasing the credit quality. So basically having more money in treasuries as part of the fixed income allocation. So making sure that our fixed income is strong, on average, intermediate term, and a healthy allocation of treasuries, and not taking too much risk with lower rated fixed income securities. Additionally, as part of the equity reduction, adding to private credit that Brad mentioned, that's an area that's done very well for our clients. We're getting nice yields there. So a small increase to private credit. And then lastly, increasing broad real assets. And that really hits the inflation theme, where broad real assets give our clients exposure to natural resource equities, infrastructure equities, commodities, tips, a broad basket of securities that should do well shall inflation repeat, and we see a reacceleration of inflation. So that's what we had for the outlook today. We had many questions submitted in advance. And I'll start, Brad, by asking you one. A good number of our questions submitted in advance ask about 2025 expectations for various asset classes and sectors. Why does Fiducient focus on 10-year return forecast rather than 1 year?
Yeah, it's a great question. 1 year forecasts are just very much fraught with error. And the reason is the thing you have to get right in a 1 year forecast is basically emotion. And emotion is extremely hard to forecast. So if you zoom out longer term and you think in, whether it's 5, 7, 10-year stretches, right? We use 10 years to capture a full economic cycle. You can be fairly predictive with where markets can and will go. But in the short term, there tends to be a lot of noise. So in building that foundational portfolio construction, 10 years allows us to capture a full economic cycle. There's actually like mathematical evidence in being able to predict that versus a 1 year it's really at the whim of emotions and much more hard to predict.
Thank you. And then we received a lot of questions about politics. I know you went into that in one of the previous slides, but maybe just to make sure we hit it, can you talk about how the new administration and election outcomes factor into the outlook?
Yeah, I mean, as we ticked through that slide earlier, the new administration, there's no question it's a pro-growth administration. You saw earlier this week, executive and emergency actions around energy. They wanted to produce more energy and grow, that portion of the economy. There's just a lot of things that are pushing forward from an economic and a market growth perspective. The flip side of the growth coin is inflation, right? So growth is good for the economy and good for markets and good for portfolios. Should we achieve growth? The flip side of that is it comes in a period of time in which we're trying to, keep the inflation genie in the bottle. It's important for us to recognize that the flip side of the growth coin is inflation, and many of the things that we were talking about, whether they're growth related, can be inflationary, and then some of them they're not growth related, i.e., tariffs or immigration, yet they are also inflationary. It doesn't mean that because administration signs a pen and does X, that directly ties a straight line to inflation. The world's just more complicated than that. But as we start to think about these new nodes of information in the new administration, we do think the risks skew a little bit higher on the inflation side. And that's why, Bob, we mentioned, some of that portfolio positioning and the introduction of broad real assets as important guards and frankly, opportunities, not just a guard against risk, but an opportunity for, portfolios to benefit from some of those macro changes.
Yeah, that's right. Thanks, Brad. Just a reminder for our participants, you can submit questions through Q&A. We have a few more I'll go through that were submitted in advance. About Bitcoin, Brad, what is your growth outlook for Bitcoin? Where does Bitcoin fit into portfolios?
Oh man, whenever price is up, people love talking about cryptocurrencies, and when they're down, they don't as much anymore. Bitcoin, it's pretty clear in our view that Bitcoin is a proxy for risk appetite, right? When markets are up, when people are feeling good about the economy, they're feeling good about AI, they feel like kind of that Mag 7 concentration, technology trade is on, so is Bitcoin. The flip side is also true, right? We saw a 75% drawdown in 2022 when things were not looking, as rosy on those same factors. So, for those that have interest in kind of the long-term prospects, right? There's always a short-term trade, and that's just not how we allocate portfolios. The long-term prospects are really centered around things like decentralizing government. We did talk about inflation today, so it's a kind of a deregulated, decentralized store of value. Maybe there's a thesis around economic digitalization, right? So you want to exchange goods, in using a cryptocurrency. However, it's important to know that the fundamental value of cryptocurrency is only worth what the next person is willing to pay for it. Whereas the fundamental value of a business, just say, I don't know, Apple, it sells a product and makes a lot of money in Apple's case, but in some other instances, not as much. But there's a fundamental economic value that is created there. And so there's still discovery on price and disagreement on Apple's price, but it has a fundamental value. A cryptocurrency, in theory, does not, right? It has no true intrinsic value. So the place in portfolios for those that really have a view and believe that cryptocurrency is going to be important to the global digital economy going forward, it's modest in size. The volatility, just to give you a statistic, the volatility, the standard deviation, how we measure it in, Bob, as you mentioned, in textbooks, the standard deviation of the S&P is about 16 or 17%. So kind of a nerdy term, but that just gives you a number of risk. The standard deviation of Bitcoin is about 92. Clearly a more volatile asset. So if it's in portfolios, it should be sized appropriately, meaning modestly, given that level of volatility, because otherwise it could really drive basically the whole portfolio's risk and outcome, and there's a lot of volatility associated with it.
Thanks, Brad. We're getting some live questions coming in. We'll start with, if inflation risk is higher, why increase the allocation to fixed income? Won't bond prices drop as yields rise? So I'll answer that. It's a great question. So it's correct that if you're in an inflationary environment, you'd expect probably the Fed to raise rates, interest rates to go up. So there are multiple scenarios for markets, different paths that they could go down. One is more of a Goldilocks scenario, which is what we've really lived in the last 2 years, where inflation is declining, growth is strong, and that's a great environment for stocks, and it's a pretty good environment for bonds. That's what's nice for investors. On the more risk lens, the environments that we worry about more, there's really two more concerning paths. One is more deflation, where you hit a recession and there's a flight to quality, stocks go down and bond prices go up as the Fed's cutting rates. So that's one potential path, and we want to make sure that we have that box covered. So that's where having more fixed income, more stability, more treasuries helps. And a different risk factor is that inflation picks up, and that would typically come with strong growth. So the economy overheating, if there's a lot of pro-growth policies and those lead to growth, but also lead to inflation, that's when the inflation-sensitive assets come in. In that scenario, your stocks should do well and the inflation-sensitive assets should do well. So the question's correct that bonds wouldn't be performing as you desire, but you'd be covered through performance from stocks and real assets. So it's really two different risk scenarios that we're trying to make sure clients have proper protection to. But good question. Another question about AI. How will Heritage use AI? How will Heritage invest in AI? And how will AI affect the functioning of the market, i.e. faster trading, more volatility, etc.? Brad, I know Fiducient's done a lot of work with AI and around AI. You want to start with that one?
So maybe taking those in reverse order. So how will it affect the market? It's a good question, somewhat unknown. The concepts around, AGI, artificial, generative intelligence, or machine learning, or, very fast trades. That's not new. It's almost old at this point, but that exists in markets today. There are not many examples of AI making trades in today's world as you just look at capital that's being allocated. But AI is being used to sort through data or suggest allocations, perhaps. So in the short term, it's hard to see the speed, frequency, or volume materially change as a result of AI, but the world is awash in data, and AI is very adept at consuming and displaying data in a way that's useful to humans. And so, that's frankly where you'll probably see more acute impact in the investing landscape and how we're using it, right? So maybe getting to the kind of some of the other questions. We literally receive millions of data points, over the year in markets and managers and the economy, et cetera, to boil all that down into not just noise, but signal. AI can be a helpful agent and arbiter to, take the top of the funnel and start to take noise into signal and actual portfolio outcomes. It also helps, employees at Heritage and in the investment industry be more efficient with their time and focus more on you and clients, rather than producing tasks or conducting tasks that may be automatable from an AI perspective. So, the world's our oyster when it comes to AI, but it's really our responsibility in figuring out how we ethically and importantly implement in portfolios. And I can tell you without question today, AI is a resource for investing, but it's not driving investing by and large.
Yeah, it's a good answer. I'd emphasize it can create efficiencies. It can be a good resource, but also anyone who's using it, and I encourage our audience to explore with it. Even I find it personally more useful for personal things like planning a vacation, for example. But it will give you wrong answers, what they call hallucinations, a scary amount of the time. So professionally, we need to be very cautious about bringing it into our investment process because of how inaccurate it can be. So we have not done that or really used it in a meaningful way. But it more starts with building efficiencies around more routine work. We have a question about ESG investments. So I have ESG investments. What will happen per Trump? So the ESG investments that we recommend for clients who have ESG approaches, it tends to focus on screening companies based on carbon emissions. So if you take a couple companies and compare them, and one has more carbon emissions and one has less, the portfolio will overweight the company that has less emissions and underweight the company that has more emissions. You might think that, for example, oil companies would do better under Trump. But if you look at the last two administrations, the energy sector did better under Biden than it did under Trump. So people tend to jump to conclusions on themes and sectors based on election outcomes, and they don't always play out. So I wouldn't read into it too much. Maybe some of the Inflation Reduction Act that came out that was favorable for greener companies, some of those things might change, and that wouldn't be good. But the way we invest in ESG, it's not just buying a basket of 50 green companies and calling it a day. It's a small tilt in that direction. So the magnitude, if something were to be more negative towards those companies, the bottom line impact would be relatively minor. See, another question just came in. Okay, so I have a lot of cash. What recommendations do you have if I wanted to take some amount out of my bank account to get a better return? So basically a cash plus strategy, Brad. Someone has cash and it sounds like they want to keep a fairly low level of risk, but reach a little bit. Do you have any thoughts there?
Yeah, I mean, we mentioned we're in a cutting cycle, right? So the Fed had cut in 2024. That directly translates to a lower expected return on cash. So, lower rates, what you're experiencing or feeling is exactly what the Fed is asking, is they're trying to compel people, to take on kind of moderately more risk. The yield curve is upward sloping, right? So you can take on a little bit more incrementally duration, basically owning maturities that are longer than a year, which is really what cash owns, technically 13 months, and add a little bit more value. There are other ways to, have cash-like outcomes, low volatility, but potentially slightly higher return through owning credit or others. Largely, though, I think the question would come back to like, if you have a lot of cash, like for what purpose? Is it to mitigate risk? Is it to fund a future spending need and getting back into those big fundamentals? Because as I mentioned, the last 2 years owning cash versus the S&P up over 20%, in 2023 and 2024, it's a more than a 15-point swing between the two. And so I would encourage, anyone, and there's many, whoever said that, you're not alone. There are many people with a lot of cash sitting in the sidelines, is to ask those kind of fundamental questions of why. And if so, then kind of where do we move from there? Because there's really good reasons to own a lot of cash, and sometimes there are less so good reasons to own a lot of cash.
Yeah, I think it gets to, it's almost a more of a financial planning question than an investment question. So what are your goals and objectives? Based on that, how much cash should you have? And if it's the right amount, then maybe we could get cute and buy short-term government bonds, but basically your cash should be cash. If you have too much cash and maybe it's from sins of the past, or someone's making a market timing decision and just kind of got stuck in that cycle of, well, I don't want to go in now, I'm going to hold cash, and it's building up. Our recommendation typically is to get where you should be and not try and time the markets there.
And by the way, the math in that, there's a lot of like, Bob, that you mentioned, there's this hesitancy to get back in. In short, the math works out that if you were to perfectly miss time, taking cash and buying the market at the very top, and then you fast forward a number of years, or conversely, you were fully invested, but you sold to cash at the bottom, it's a far better outcome to buy at the top, with cash and, let markets run than it is to invest and then sell at the bottom, right? So even if it ends up being an error, it's a lesser error than, owning a portfolio and selling all at the bottom.
Seems like our cash conversations are prompting more interest in cash, so as these questions come in. So what is the current thinking of how much cash to have on hand so as not to negatively influence your portfolio? So I'll take this. And the financial planning textbooks say 3 to 6 months of living expenses. So that's the typical base case, that you should have 3 to 6 months of living expenses in cash. And I'd add to that living expenses or major expenditures. If you're buying a vacation home in 3 to 6 months, I'd put that on the cash bucket. So that's like real short-term needs. And then beyond that, we tend to lean towards investing in a diversified portfolio. But it is a personal question. Some people err on the lower end, some on the higher end, but that's roughly what we recommend with cash. And then a question on the 20-year treasury. So thoughts on 20-year treasuries, if it's retirement or even shorter term money. So Brad, I'll let you take that.
There's a lot wrapped up in the long bonds, long treasuries, the 20-year, the 30-year, probably even more acutely. The price volatility of that is going to be dictated on just a handful of things over the coming, however you're defining a shorter time period, quarters, months, weeks, years. Deficit policy, inflation, and currency are largely going to be the biggest drivers of that. So if we see increased inflation, the impact of that is going to be much more felt in long-term treasuries than it would be in intermediate or short-term treasuries. Also, the other side of that coin is, the current debt to GDP of the United States is 120%. And we have a high level of deficit spending today. Long term, we need reform around things like entitlements and/or defense to have, a balanced budget, and we don't have that today. Those discussions and potential changes good or bad, are going to materially influence the price action of 20 or 30-year treasuries. So if you're a buyer of 20 or 30-year treasuries, which by the way, we wouldn't recommend because you're just making a very kind of singular bet, you're basically hedging against a very certain scenario. The economy weakens, that markets weaken, and therefore inflation weakens. And we go into kind of more of a prototypical recession. And so rates rally, the Fed starts cutting, and those positions, prices move up a lot. All other scenarios, it's kind of all bets are off. And it's gonna trade very heavily on those short, small numbers of factors. So it's a very narrow trade. I would specifically call it a trade rather than investment, to be that far out on the curve.
Yeah, the way that the math works with the price changing as it's sensitive to interest rates as you go longer term on a fixed rate bond, you could easily see 10 or 20% swings in price. So for something that's needed for short term, we wouldn't advise going out to a 20-year treasury. The level of risk is closer to stock-like volatility, even though it's a government bond instrument. Couple more questions submitted in advance. Maybe just quickly, Brad, you did touch on residential home prices earlier. Do you have an outlook there to share?
Uh, it's all dependent on location. There is some driving factors. High levels of current mortgage rates mean existing home supply. So those that are willing to sell their home and effectively forego their lower mortgage, locked-in mortgage rate is low. And so housing supply is low, and that's largely been the driver of upward demand. Now, there's a number of other factors which are more acute to kind of those local areas. For example, in California, just lost thousands and thousands of homes, and they are very, very short on supply. And so the supply versus demand effect in those markets are going to be much more acute. So it's hard to just make a blanket statement around housing, given all the nuances of all the different areas of the United States. But one of the few blanket statements that can be made is supply is fairly low. And that has been kind of propping up, if you will, prices. And so there's not a whole lot of catalysts in the near-term future that would be materially increasing the supply of housing. So we would expect housing to be, somewhat stable, if not modestly continue to rise in the future. And then there's a lot of detail on, the geography and the city and the state and the house, et cetera.
All right. Thanks, Brad. All right. One last question. I know as we share our market expectations with clients, they sometimes see that we're expecting higher returns from foreign equities, international developed and emerging markets than US. And we get the reaction of, yes, but hasn't the US done so much better than foreign markets? Why would I want to own that? So questions along those lines. And I imagine at Fiducient, you hear something similar. So we have this slide put together. Brad, would you mind walking us through it?
Yeah, it's kind of a 3-point display of how not how unique of a time period we're in. So the S&P in the upper left here, this is the S&P market cap. So kind of the total value of the S&P relative to US GDP. And it's the highest that it's ever been. Now, if you also contrast that on the upper right, the S&P total value versus the world's GDP, it's also the highest it's ever been. So the S&P is commanding a higher share relative to economic growth here in the United States and the world, really since the data has been tracked. Also, relative performance of the S&P versus international. This is the longest period of outperformance, dating back to the 1970s. And one of the things that, there are very few constants, but one of the things that is constant in markets is that things are always changing. And it's easy to gain comfort looking in the rear view mirror and saying, well, the S&P has been really the only game in town, and more acutely, it's been a handful of stocks in the S&P that have driven the vast majority of the return. The next 10 years will do exactly the same. Rarely does that actually happen. In the 1980s, it was by far and away this wouldn't read American exceptionalism, it would read Japanese exceptionalism. In the 1990s, then it turned into US tech stocks. In the early 2000s, up until 2008, it was actually emerging markets in China, that were on a hard run. Then we went through '08. So the cyclicality of success of these big, broad, US versus international versus emerging, are always changing. And I think we would be foolish to think that looking in the rearview mirror, it would just be an exact repeat. Now, that doesn't mean that we should allocate all of our money outside the United States. There's a lot of balance and intentionality around the global design of that portfolio and leaning into opportunities and leaning away from risks. One of the risks we talked about is concentration here in the US. That's an acute US large cap problem. Small caps in the US are not concentrated. The largest stock in the Russell 2000 is 0.5%. International, including Europe or Japan or in Asia, markets are far less concentrated. And so one of the ways to mitigate that risk is to have a globally facing portfolio. But we think for a whole host of other reasons, most notably of which we try to invest looking forward, not in the rearview mirror, that there is opportunity outside of the United States. And then lastly is we don't have to own everything outside of the United States if we own something outside of the United States, right? You don't have to own all of Europe. You can own select great companies in these various regions, through active management or through intentional index design, rather than having to own 100% of what exists out there. So I think those questions are very well founded, and especially recent history would prove it quite wrong. But if we zoom out and take a bigger look, we think there's a lot of opportunity that a global portfolio can address.
Thanks, Brad. I'm just going to hit one question that just came in again while you were talking quickly. So it's on AI again, and talking more from the lens of investment opportunities, such as NVIDIA. And Brad talked about concentrated consequences, how the US market is concentrated in the big names. They mostly are tech companies. And they are companies involved in AI. So our clients and investors will have exposure there. What we've heard, and it does make sense to me, that some of the biggest winners will be within AI will be the larger companies because it's so expensive to participate. But then the question is that built into the price? And I think a lot of it is. That's why NVIDIA is now the largest company in the US market. So you get exposure through large tech in the US, and then beneficiaries of AI can also be not immediately intuitive, but more companies that will leverage AI for efficiencies, such as financial service companies. So you can get it through broad market exposure. And then the question asked about ground floor opportunities. For our qualified purchaser clients, we do invest in private equity, venture capital, smaller managers who invest in private equity, and that's where you can get some of the more high octane types of investments that I think this anonymous attendee is looking for. So a wide range of ways of getting exposure to AI in portfolios. So with that, we'll wrap up today. I want to thank Brad for joining. We appreciate the presentation and your contributions in our partnership with Fiducient. So thank you very much, Brad. And our attendees, thank you for attending. We appreciate your time today. Thank you. And thank you to our clients who attended, and thank you for being clients of Heritage Financial. Thank you, everyone.
All right. Thank you all.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts, and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.